Assalamu alaikum everybody. Welcome back to my channel Rapid Revision. Today's video is on a past paper question, and this question is from other payables and other receivables. The question here is saying the following balances have been taken from the books of RB, a trader. So this is also from October-November 2022. This is paper 2 variant 1. Also this is question number 3. The question here is saying insurance account has a balance brought down of 2500, and they're saying it's prepaid at start. And I know it's start because this is the first day of the year, 1st April 2021. Then they're saying there's a prepaid carried down in the account of insurance at 31st March 2022. They have given you $850 prepaid. Then there is a commission receivable balance. So there's an opening owing and commission receivable that is $700. There's a closing owing and commission receivable that is $630. Then they're saying the following transactions relate to the year ended 31st March 2022. All receipts and payments were through the bank. They have given you what we have paid for insurance is 15,300. We have gotten an insurance refund. That means that we made an overpayment. So let's say this 15,300 was an overpayment that we made, and we got a refund back. So we'll have to deal with that in the insurance account. Then they've given you commission receivable. 7,200 were received for commission during the year in the bank. So now they're saying prepare the following ledger accounts for the year ended 31st March 2022. Balance the account and bring down the balances on 1st April 2022. So what you need to know here is that the expense has this rule, the expense account. The rule is POOP. So P stands for prepaid brought down, O stands for owing brought down. So prepaid brought down always comes on the debit side. They have given you a prepaid brought down at start. For insurance, they've given you $2,500 prepaid. So I'll write here $2,500. I'll write here 1st April 2021. This is my prepaid brought down. Also, there is a prepaid carried down. I'll write it here, prepaid carried down. I'll write here 31st March 2022. And this will be $850. Then they have given us some amount for what we have paid for insurance is 15,300. For insurance, if we've paid 15,300, the double entry for payment will be insurance account debit, bank account credit. So in the bank account, you'll write insurance. In the insurance account, you will write bank here. So you will write here bank, and you'll write here 15,300. And you don't know the specific date for the payment, so you need to write the last date, 31st March 2022. And the refund that we have received from for insurance, for refund, the entry will be opposite of the payment entry. The payment entry was insurance debit, bank credit. The refund entry would be bank debit and insurance account credit. So I'll write here bank. I'll write here 600. This is for insurance. Also, I don't know the specific date, so I'll write here 31st March 2022. Now what I need to do is that I need to calculate my value for income statement, and that is very simple. One thing that I always tell my students is that the bank value, wherever is bank, opposite is income statement. So I'll write here income statement. Wherever you're recording the payment for an expense, on the opposite side you record income statement, and this is basically how much we are transferring to the income statement for insurance for this year, that is for the year ended 31st March 2022. So I will total the debit side. The total of debit side is 2,500 plus 15,300, which is 17,800. The total of credit side will be 600 plus 850 is going to be 1450. Yes, 1450. So 17,800 minus 1450 will give me 16,350 is what I'm going to transfer to the income statement for insurance as an expense. So I will balance this account at 17,800 on both sides, and this balance carried down will become my prepaid brought down, and this will be $850. So you should know this, that even if you look at the marking schemes, you guys will see that they haven't written prepaid brought down, they've written a balance brought down. That's also fine if you write balance brought down, and if it's a prepaid, you record it on the if it's a brought down, you record it on the debit side. If it's a carried down, prepaid carried down, you always record it on the credit side. And that's it for the insurance account. This is an expense account. For commission receivable account, you need to know the rule, that is OPPO. O stands for owing brought down, P stands for prepaid brought down. Again, P stands for prepaid carried down, and O stands for owing carried down. So owing or brought down always comes on the debit side. So there's a commission receivable owing brought down. I'll write here 1st April 2021, and my owing brought down here is $700. So I'll write 700 on the debit side. My owing carried down in this question is owing carried down. I'll write here 31st March 2022. I'll write here owing carried down, and I will write here 630 is my owing carried down here. And then we have 7200 in the bank, which we have received. So bank is being debited, you need to credit this here. Here you need to write here bank, and you need to write here 7200 as what we have received for commission receivable. I'll write here 31st March 2022. And then I need to calculate my income statement. Again, the same rule that I tell my students always is that wherever is the receiving of the money, so in the income account you record the bank value on the credit side, because the bank is being debited, income account is being credited. On the opposite side, you'll have a transfer to the income statement. So I'll write here income statement, and my income statement will simply be 7200 plus 630 is 7830. 7830 minus 700 will be 7830 minus 700 will be 7130. This is my income statement, and this is the value of the income for commission receivable that will be added to my gross profit in my income statement. So I'll write here 31st March 2022, and this account will balance at 7830 on both sides. This owing carried down will become my owing brought down. So I'll write here owing brought down. I'll write here $630. This will be 1st April 2022. So yes, this is my commission receivable account. In the next part, they're saying prepare the entries for insurance and commission receivable in RB's statement of financial position at 31st March 2022. So you guys should know this, that for statement of financial position, always prepaid expenses. So prepaid, and there is current asset. Prepaid expense is a current asset. Prepaid income is a current liability, and owing expenses is a current liability. Owing incomes are current assets. So that means we have a prepaid we have a prepaid and insurance, which means we have paid extra for the next year. Again, this is my current asset. This is also called other receivable. These both of these are called other receivables in accounting. And there is an owing income in commission receivable, that is 630 at end, $630 at end. So I need to record both of these as my other receivables. So I'll make the extract of the statement of financial position. I will simply make 2 lines here, and I will write, so these are dollar values, so I write dollar here. I write here current assets. So basically what you needed to identify was that these are current assets. You write here current assets, you write here other receivables, and you need to add both of these amounts. So insurance, other prepaid insurance here is $850, and owing commission owing here is $630, which you will add here. 630 plus 850 will give you 1480 is my other receivables, which is both. I have a prepaid expense and I have an owing income in this case. So if you guys don't know what is the logic behind all of these things, so you can watch other videos of mine in which I have explained this from the very basics, which is basically on the concepts of other receivables and other payables. But you guys should know that prepaid expenses and pre-owing incomes are both your current assets, and they are also called other receivables in accounting. Yes, in the next part, I've already written this here. Explain why the matching principle is important in the preparation of RB's income statement. So I'll write here. You can write here. matching principle says that revenues of one period should be matched against the cost of the same period. So if we have paid extra for next year, that should not come in the current year's income statement, because that is not the current year's expense. Also, one more thing that the accruals and matching principle says, that expenses are recorded when the service is used up. If we have paid extra for next year, that means we haven't used the service yet, so we can't record that as our expense in our income statement. So by applying the matching principle, the correct amount of revenues or expenses are recorded. So that means owing prepaid is not recorded in the current year's income statement, whether it's an income or it's an expense, and owing is always recorded. So if you so owing is basically whatever we still owe. Like if it's an owing expense, you need to record that in current year's income statement, because owing expense means that we have used the service but we haven't paid for it. But prepaid expenses means that we have paid for the next year, so we can't record that because we haven't used the service yet. Similarly, for incomes, owing incomes are always recorded in the current year's income statement, because owing income is like we have given the service but we haven't received the money. So in the current year's income statement, we need to record incomes according to the service we have given, not according to the money that we have received. So that is the accruals and matching principle. So we need to record this as our the owing income as our income in the current year's income statement. We will record that as our income. So prepaid income is not recorded in the current year's income statement, because prepaid income is like we haven't given the service but we have received the money in advance. So that is why prepaid is never recorded. Prepaid is always subtracted, and owing is always recorded. Prepaid is for relates to next year, owing relates to the current year. In the next part, they are saying RB has arranged with its suppliers to receive a 25% discount off list price and a 2% cash discount. The cash discount is only for payment made within 10 days. So there is a concept of trade discount and cash discount. So if trade discount is basically given and taken at the time of sale or purchase, so whenever we are selling goods to our customers, at that time we will give a trade discount. Also, trade discount is given on the list price. List price is the price on the label. So RB, the suppliers of RB are giving him a 25% trade discount and a 2% cash discount if he pays within 10 days. So basically the trade discount is given because of customer loyalty. So customer loyalty or bulk buying, we give them like our suppliers would give us a trade discount because we have been purchasing from them for a very long time, or we are buying goods in bulk. So 25% trade discount and a 2% cash discount. So the cash discount is only for that we have read here. On 5th March 2022, RB received an invoice from JP for the supply of goods with a list price of 3,000. The invoice was paid on 13th March. So 5th March and 13th March. So he is entitled to both. He is entitled to a trade discount. Also, he is entitled to a cash discount because he is making the payment in 8 days. That is on 13th March. So in around 8 days. So what you'll do is, for trade discount, you'll do 3,000 multiplied by 25 divided by 100. So 25% of 3,000 will be $750. So $750 is what he's receiving as trade discount. So that means the goods that he is buying from the supplier, he's buying them for 2250, that is $2250. He's purchasing those goods for $2250. Then the cash discount, you need to simply apply cash discount on $2250. So he is supposed to pay 2250, but now he'll pay 2% less. So 2% of 2250 will be how much? 2250 multiplied by 0.02 will give me $45. So $45 is what he'll pay less. So what he'll pay actually will be 2250 minus 45, and this is 2205. So I'll write here the calculation. One second, I need to write the calculation here. I'll write here 2250, which was the amount that RB was supposed to pay, minus $45, which will give 2205, which is the amount that RB will pay to the supplier supplier JP. Then they are saying here, complete the table below indicating with a tick the effect of each type of discount on gross profit and profit for the year. So discount allowed is not going to affect gross profit, because till the gross profit you are not recording the discount allowed or discount received, because simply the till the gross profit section, that is the trading section of the income statement, above that you are not you never record discounts. After that, in the add other income section, we record discount received, and in the less other expenses section, we record discount allowed. So discount allowed is not going to affect the profit, the gross profit, but it is going to decrease the profit for the year, because discount allowed is an expense. Expenses always decrease the profit. And discount received is not going to affect gross profit, no effect on gross profit, because before gross profit you're not recording discount received. After gross profit we record discount received in the other income section. So discount received is also going to increase the profit for the year, because it's an income, and incomes increase profit. So that's it for this question. Thank you so much for watching. Hope this helps you.